all asset prices are high. There are very few bargains around. There's nobody, there's no forced sellers. There's no panic. So it's hard to get a bargain. Yes, stock prices are high, but the good news is that the economic recovery is young and probably has years to go. So I don't worry about a recession or the market topping out anytime soon.
And as a young student pursuing the financial market stream, it's necessary reading books, and one great reference is Mastering the Market Cycle. In this subject, what would you say is the market cycle that we are currently in? And given the low interest rates, what are the investment opportunities?
First of all, you have to realize that I've been through now 52 years of investing, and I've lived through, 5, 6, 8, 10 cycles. And, I've studied the cycles. I believe cycles are very important and so forth. But the things that happened last year were not cyclical events. You have to realize that. The coronavirus was an exogenous event. That means it came from outside and, as a shock, and the most serious health event in the last 100 years. And then in order to prevent the spread of the disease or limit the spread, most countries shut down their economies. You can't have people going into stores, movie theaters, restaurants, concerts, et cetera, and hotels. And, they would just pass the disease on. So they closed all that. But of course, that brought on a very serious recession, the worst recession in history in terms of the second quarter of last year, down a third on an annualized basis in the US. And that wasn't cyclical either. That was a man-made recession and a man-made closure. So the key is, of course, that the Fed and the Treasury took very strong action to rescue the economy, and it was very successful. And so the market came right back. Just to give you some perspective, the S&P 500 was around 3,300 on February 19th. 35 days later, on March 24th, it was 2,200. So it went down by a third in just over a month. But then the Fed and Treasury took their action. March 23rd was the low. Market went pretty much almost straight up from there. It closed the year up 18% for the year, which means it was up about 60% from the low. And today it's up 100% from the low. Now, your question is, where do we stand cyclically? This is a great question. Normally, good economic news makes the market go up. Bad economic news makes the market go down. So normally, the market and the economy move similarly, not exactly the same. There are leads and lags, and one goes first and the other goes second. And the leads and lags vary from cycle to cycle. But for the most part, the market rises as long as the economic news is good. Sometimes it declines in anticipation of a slowdown. But then when the economic news turns bad, then the market turns bad and that goes down. So the two cycles are related and largely in parallel. This time, that's not the case. This time, the market has been very strong now for a year and a half, since March, on September 23rd, it'll be a year and a half from the low. Market's been extremely strong, as I described. All asset prices are high. There are very few bargains around. There's nobody, there's no forced sellers. There's no panic. So it's hard to get a bargain. On the other hand, the economy it's in recovery, but it's early in its cycle. The last year, the third quarter was the best quarter in history, also up a third on an annualized basis. And then the growth has been good in the first and second quarters of this year, up 6-7%. but it's young. So we have a young economic recovery, which we imagine will go on for some more years. But we already have a market which is very high. That's unusual. So now the key is, okay, those are the facts. The key is, what is the significance of that? You could say, Enrique, I'm worried because the economy isn't completely strong and stock prices are already very high. So, I worry. But you could also say, yes, stock prices are high, but the good news is that the economic recovery is young and probably has years to go. So I don't worry about a recession or the market topping out anytime soon. And, my own feeling, I mean, the market is quite high. There are things that are troublesome, worrisome in the market. But I think that as long as the economic news is good, the market is not going to correct. The last thing I'll say about the market, and it's not related to cycles, is that asset prices are very strongly affected by interest rates, because the Fed sets what's called the Fed funds rate, which is kind of like the riskless rate, the base rate for all markets, and then the demanded returns on securities scale from that, because everybody says, well, if I can get X on the market on the risk-free rate, if I'm going to take some time risk, I need 100 basis points. If I'm going to take corporate risk, I'm going to need 300 basis points. If I'm going to go to high yield bonds, I need 500 basis points, and so forth. And equities, I need 700 basis points, whatever it might be. So the riskless rate sets the floor, and everything scales up from there. But of course, the riskless rate is so low that the demanded returns and the a priori returns, I don't know if you know that term. A priori means what we're looking at in the future. They're all very, very low. We have the lowest interest rates in history. So it wouldn't be unfair if we had the highest prices in history and the lowest prospective returns in history. I wrote in my last memo that a bubble is an irrational state, and today's prices are not irrational. They're rational based on interest rates. Things are priced fairly relative to interest rates and relative to each other, but they're priced high. Obviously, if they're priced high because interest rates are low, then if interest rates rise, that's a source of exposure. And you can lose money, because if interest rates rise, prices will go down, probably. So this is something to think about. And again, you have to figure out whether you think interest rates are going to stay low or not. My own guess is interest rates will stay low-ish. Ish means sort of. Not as low as they are today. They'll, 2 years from now, they'll be higher, but I don't think they'll be terribly high.